A very good afternoon, students. We will be discussing about the investment alternatives today. So, before we could understand what you mean by investment alternatives or investment vehicles, let us understand what are the different classes of investment that an individual can choose. So, an individual can choose two main classes of investments. That is, I have already discussed in the previous class that investment are made for certain returns. You are going to save today in order to get a return of it, which can be utilized on a future date. So the returns, based on the returns what you get, we classify the investments. If you're getting a fixed income on your investments, you term it as fixed income investments. Example, your bonds, fixed deposits, preference shares, etc. And if your investment is going to fetch you a variable means varying rate of return. So what you're receiving this today, you may not receive tomorrow, or what you're receiving, the rate of interest you are receiving, return what you're receiving today will not be the same tomorrow, or what you're receiving this month will not be the same next month. We call such investments as variable income investment, where the return is not consistent, it keeps varying. So under variable income investments, we have equities or it could be real estate, example, your properties. Now coming to what you mean by investment vehicles, or we call it as alternative investments or different avenues of investment. What do you mean by investment vehicle or avenues of investment? It refers to those investments, alternatives or vehicles or the avenues which the investor chooses for making the investment. Basically, these investment vehicles will be chosen by an individual based on the risk involved into it. If he wants to take up higher risk, he will invest in higher risk. That means based on risk and return. If he wants a higher return, then he would take up higher risk. If he wants lower returns, he will take up a lower risk. Okay, so that's about your investment vehicles. So there are three different types of investment vehicles. We have the first classification as ownership investment. So as the name suggests, when you are purchasing these investment avenues, you take the ownership. Say, for example, stocks, your equity shares. It could be your business. It could be your real estate. It could be precious objects and collectibles. It could be jewelry, ornaments, monuments. All these come under your ownership investments. The second classification is your lending investments. Under lending investments, we call lending investments that allow you to be the banker. You will be lending the money. So you own the money, but you are going to lend the money as an investor. So they tend to be lower risk than ownership investment and return less as a result. So a bond issued by a company will pay you a set amount over a period of time, while during the same period, the stock company would double and triple, and hence the return on the company stock would be more than the bond. So your saving account, what you are making, is a best example of lending investment. You are essentially lending the money to the banker, and the banker in turn is lending in the form of loans to the external people, or he is investing in other avenue. So here your investment is in the form of lending investment. The third kind of investment that an individual could make is cash equivalents. That means investment that is as good as cash, that could be easily converted to cash, is called as cash equivalents. Say, for example, your money market funds, or it could be investment on your education. You're spending on education to get your returns. That is, in order to have get a job, or in order to get into a business, so that you are going to make money. So this investment is not seen. It's not. It's basically there's no physical evidence for it, but you are going to get money out of it. Or it could be money market funds or capital markets in which you are investing is called. So other classification of investment is physical investment, financial investment, marketable and non-marketable investment, transferable and non-transferable investment. So what do we mean by physical investment? As the name suggests, physical investments refers to those investments which are said to be tangible in nature. It could be your capital goods, it could be furniture, it could be your vehicles, it could be fixed assets. that are useful for further production. So they could be financial goods, or they could be capital goods. Basically, they are economic goods, economic investment. So capital goods like plant and machinery. So some of them could be ornaments, or like ornaments are not useful, but ornaments are going to be physical investments. It is not only useful for production. Ornaments will not help you in any way for production, but they also have physical existence. So it could be physical or non-physical in nature. I mean to say physical in nature, but they might be used for production or they may not be used for production. Next is financial investment. So financial investment is an investment that you make on goods and services for a creation of assets. It could be a financial asset or it could be a financial asset. So financial investment is used for consumption of products or goods or services, or it could be for further creation of assets. It could be in the form of shares and debentures. Marketable and non-marketable investment, as the name suggests, you can market them or you cannot market them. Say, for example, your shares can be marketed, whereas your bank drafts cannot be marketed. Transferable and non-transferable investment. Transferable means that you can that means if it is marketable, it becomes transferable. If it is not marketable, it is not going to be non-transferable. It cannot be transferred. That's why it is termed as non-transferable. So we have two different kinds of investment avenues. One is short-term avenues, and the second is long-term, or in other words, we call them short-term vehicles and long-term vehicles available to the investors. Now, what is short-term investment? So a short-term investment plan is where the money is invested for a shorter period, ranging from few days to few months. It could be 30 days, it could be 40 days, it could be 70 days, it could be 90 days, or it could be a year or more as well. So when it is for a shorter period, some say it is for a year, some say it is for 3 years, and some call it as 5 years, depending upon the nature of asset what you have been purchased. So a shorter term investment is usually for a lesser amount of investment. So usually your short term investments will be very small in nature. So the motive here is to yield a constant and slightly variable return, but not high returns. Okay, so here you cannot expect high returns. If you expect high returns, then you have to go for large amounts and long investments. So if you have to reap the benefits of a long-term investment, then you have to make it for a longer period of time. What are the different short-term investment avenues? They are savings account, which you can open in your bank, your normal savings bank account, your liquid funds, it could be, where can you usually convert into cash, your recurring deposits, national savings certificates, fixed maturity plans, commercial papers, asset-backed commercial papers, promissory notes, repurchase agreements, letter of credit, asset-based loan. Now, coming to the next investment vehicle, long-term investment. What do you mean by long-term investment vehicle? Long-term investments are vehicles that you can expect to pay off after holding them for a period of many years. When investment is for a longer period of time, it is going to be called as long-term investment. What is the difference between short-term investment and long-term investments? Is there a difference? Yes, there is a difference. We can identify three important differences. They carry different expectations. Long-term expectation is totally different. Your short-term expectation is totally different. Your short-term expectation will be something like your child's education. It could be your child's marriage. Whereas your long-term expectation could be you traveling for a trip, for a long trip. Next, the satisfying different goals. They each short term is for a different goal and long term is for a different goal. That means the means of satisfying that is going to be different. And a risk involved in short term is said to be less when compared to long term. Okay, so now what are the objectives of long-term investment? The objectives of long-term investment is basically your education for children. It could be your marriage of children. It could be purchase of house. It could be setting of retirement corpus. It could be or any other long-term financial goals that you want to achieve. So long-term investment options are provident funds, gold investment, mutual funds, real estate, long-term bonds, national pension scheme, post office savings scheme, national savings certificate, monthly income scheme, recurring deposit schemes, and Kisan Vikas Patra. These are the different avenues available to the investors. Now coming to the features of investment and process of investment. Now let's look into the features of investment. So the first feature of investment is risk factor. Any investment for that matter, there involves risk. Short-term investment, less risk, and long-term investment, low risk. Expectation of return is there, either short-term or long-term. Expectation is there. No investment is made without any expectation. There is said to be an expected rate of return. Next is safety is very, very important. Before you could go for making an investment, definitely people look into safety. If you are risk averse, you look more into the safety aspect. And one more thing is liquidity. Any investment you are making, either short term or long term, liquidity is very, very important. You will have to, or you wish to convert into cash liquidity within a short period, because every investment is made with an intention of um, reaping its benefit on a future or enjoying the benefit of it on a future date. But there can be uncertain contingency that happens in our life. It could be accident, it could be health issues, it could be anything where the need for money is there. So when the need for money is there, then you have to convert your investment into cash. So there should be liquidity. I take up a health insurance when I'm not well. I must be, when I'm hospitalized, I need that money quickly. If I'm not able to liquidate it, then there's no fun in taking your health insurance. Next is marketability. Not all insurance, not all investment, but certain investments, there has to be marketability. Say for example, your SB cannot be marketable, right? But your shares could be marketable. So stability of income. So this is another feature of investment, that any investment you make, you always expect the stable income. Next is safety of principal is very, very important. If not return, at least my original amount, I would expect to get it back. So safety of my principal amount is very, very important. And appreciation of capital. Whatever I have invested, I expect the increase in the value, because we know that time value of money, the value, what a rupee what you have today has more value than a rupee what you're going to receive tomorrow. So that's because of the various factors that are happening. So there must be capital appreciation, otherwise it's of no use. Next, purchasing power stability. That's what I told you. Today I have a rupee, I would be able to purchase something for it, but tomorrow the same rupee, the same object cannot be purchased. That's because of the marketing cycles, that because of inflation. So you need to ensure that if I'm able to purchase a product today for 1 rupee, and this rupee value should increase tomorrow to the same value how much I'm able to get it. Next is tax benefit. Any investment I make, there is said to be a tax benefit. And for that purpose, an example, you buy a house, you construct a house, you take a loan for it, there's a tax benefit given to it. So otherwise you will not take it, because that's going to be a huge burden to you. And legality, there's huge rules that are going to be available in making your investment, be it your stock, be it your shares, or be it anything else. Next, we are coming to the investment process. The first step is investment policy. That is, an individual needs to analyze his need and his potentiality to make an investment before he could go for choosing the different avenues, either it is short term or long term. So based upon his objectives, that is need based, and the potentiality, his financial capacity, you have to decide upon the investment, and that is what we call it as investment policy. Next is step 2, investment analysis. Now, based on your potentiality and based on your need, what are the different avenues available in the market? So you try to analyze that, and that is called as investment analysis, out of which you're going to choose those avenues which are going to best suit your need and your capacity. So once you choose them, next step is you're going to evaluate the securities. You need to analyze each and every security, whether they are correct to you, whether they are adapted, whether they are said to be depending upon your need. So you need to go for valuation of securities, keeping in mind the criteria based on your objective, based on your need, based on your potentiality. You need to analyze the security by telling what is it going to serve my purpose, short term or long term. And once you have decided, you are going to construct a portfolio, because you need not have a single investment. You can have a combination of investments. It's good to have more number of investments. That is the reason why we say that too many eggs into one basket is going to spoil your eggs. You need to put eggs in different baskets so that you can protect those eggs. Similarly, in order to ensure that you get a stable and consistent return, you need to have investments in different portfolios, in different avenues. A combination of both short term and long term you need to have, so that you have a good portfolio which will give you a standard consistent return. So these are the 4 steps in investment process. So with this, we come to the end of the class. We will see the next concept in the next class. Thank you. Have a nice day.